How's it going, everybody? It's Stas here. So in this video, we're going to be talking about 3 mistakes that you need to avoid in the stock market, whether you're just starting out, you're a beginner, you're intermediate, you're advanced, you're day trading, swing trading, long-term investing. These are mistakes that you need to avoid. They're pretty much universal stock market mistakes to avoid, and they'll save you money, they'll save you time, which is super important in the stock market, and trust me guys, I'm speaking from experience, they'll save you a lot of headaches. And before we even get into the video, guys, all I ask from you is if you find value in this video, hit that like button for me, consider subscribing to the channel, and feel free to pick up 2 free stocks from Webull if you guys want to. Link down below in the description box. All you have to do is deposit $100 into the account, and that's when you get your 2 free stocks, and I also get 2 free stocks, and that is a way to actually support the channel for me putting out all of this free content. And let's just get right into it. So mistake number 1 to avoid is investing or trading with money that you can't afford to lose and money that you need in the short term. So let's say I'm just average Joe. I'm not Stas. I'm average Joe. My name is Joe, and I don't have an emergency fund. I have a tax bill coming up. I have my daughter's graduation coming up, and she's going off to college, and I need to pay some money for that. And I'm investing and trading with money that I'm probably going to need to take out for one of these events, whether it's tax day, whether it's my daughter, or whether it's any emergency bill that comes up. That is not a situation that you want to be in, right? You want to be in a situation where all of the money that you have in the markets, you can let it ride for a couple of years. You don't have to take that money out from your investing, from your trading account, whatever, in the short term. You don't have to incur that tax because you guys know if you sell something in the market, especially if it's a profit, right? If you're selling at a profit, you have to pay a capital gain, whether it's long-term capital gains, short-term capital gains. So the last thing you want to do is you have a stock market portfolio doing well, and you don't have an emergency fund like we talked about, you don't have any cash set aside, and the money that you're using in the market, you need it in the short term. This is the last place you want to be because you're going to have to cause a taxable event by selling out of your stocks or ETFs or index funds, whatever, and you're maybe cutting the potential of those positions short, because we all know if you do your own research, good research, invest into good companies, that have good prospects, if you're cutting out of the position before that company reaches full potential, you're missing out on a lot, right? You're missing out on a lot of potential growth and a lot of potential money because you're investing, you're trading with money that you can't lose in the first place, or money that you need to take out for something in the short term. So the moral of the first mistake to avoid is just invest and trade with money that you don't need over the next couple of years, right? Always have your basics set in place. And by basics, I mean have a savings account. If you don't have an emergency fund in place of about 6 months of expenses, don't even start investing in the stock market. Don't even start trading, because if something happens and you need that money you need to take out, the last thing you want to do is take it out of your market portfolios. What you would want to do is take it out of a cash account, whether it's an emergency fund or just a general savings account. That is what you want to do rather than taking it out of the stock market. The second mistake to avoid is do not marry a stock. Do not marry a stock, and do not fall in love with a stock, because the stock market can stab you in the back. Individual stocks, they can also stab you in the back. And the last thing you want to do is, let's say, for example, I'm in love with McDonald's stock. The last thing you want to do is invest all of your money in McDonald's, watch the business deteriorate fundamentally, and still be obsessed with McDonald's. I mean, let's say they have 30,000 restaurants open roughly right now. Let's say they have to shut down 20,000 restaurants. They're losing customers left and right. The demand for McDonald's is going down, and I still have my money in it. I'm still riding it out, although the fundamentals are deteriorating, the future's not looking bright. The best thing to do is don't marry a stock. Okay, have a plan. Let's say I'm going to invest in McDonald's. I'm going to hold it for 5-10 years at first. That's the initial plan. I'm never the type of guy to be like, I'm holding this stock for life no matter what. I'm always the type of guy on the flip side to have a 5, 10, 15-year plan. And if things go off track during that time period, I'm never the type of guy that is just going to hold the stock anyway. I'm not scared to cut my losses, to cut the stock short, to maybe, just put some money elsewhere and even take a small profit with the stock too. I'm never the type of person to just hold on no matter what. So avoid marrying stocks, guys. And if you're getting into a company and, whether it's Apple, Microsoft, Amazon, whatever company it is, guys, doesn't have to be tech. It could be maybe tobacco stocks, maybe, Colgate, maybe Procter & Gamble, whatever. If you're getting into a company and the first year or 2 you're investing it's going well, the company's doing well, but you notice it's starting to deteriorate and you love the company, but you notice it's deteriorating, you have to just let go. And, you have to maybe cut losses and reevaluate the situation and put the money into a business that's prospering, because why would you want money into a company that's decelerating, that's going down, that is losing money, and the future's looking bleak? You rather be somewhere where the future's looking good. You don't want to be in a company that's pretty much dead weight. So the second mistake to avoid is never marry a stock, an industry, an index, whatever. Don't marry anything in the stock market. And now let's get to the third mistake. So mistake number 3 to avoid is do not invest or trade instruments, stocks, ETFs, bonds. Don't do anything that you do not understand. And understanding what you're doing is the most important thing in the markets by far. It's super important. It might not be the most important, but it's definitely up there as the most important, because if you don't know what you're doing, you're relying on other people to kind of spoon feed you. I mean, you guys have heard the quote, give a man a fish, you feed him for the day, give a man, teach him how to fish, you feed him for a lifetime or whatever. You guys know that quote. That is the same thing in the markets, and especially when you're trying to invest or trade in the markets. Do not do anything that you don't understand. Trust me, I see this all the time. Beginners coming in, shooting me messages either on the comment section, YouTube, DMs on Discord, Instagram. They're asking me, they're beginners. They're asking me, Stas, can I get into options trading? How do I flip my little 300 account into 1,000 and then that 1,000 into 10,000? And the truth is, guys, these people, they don't even understand how the stock market works, and they want to jump right into options trading. The truth is, you have to understand how the stock market works at first, and that takes a couple of years, guys. Understand how the stock market works, and then you dive into options. Once you understand how the market works, how to read technicals, how this affects that, how things are all intertwined, it's kind of like a web. Once you understand all of this stuff, then you could jump into options once you're more competent, once you're more intermediate advanced. And that's kind of on the trading side, one thing that, stands out to me a lot, right? And one thing that people do without even understanding it. Options trading, you must understand this. And when you're looking at, let's say, long-term investments, when you're looking to buy a company, you want to buy stock in that company, you must understand the company's competitors, how the company makes money, how many threats does the company have? Does the company have potential? Is there a future market? What's the size of the market now? What's the market that this business is going for? What's the size of it going to be in the future? You have to ask yourself these questions, dive into it. How does the company make the products? How much does it cost to make the products? How much are the competitors' products products, how much do those cost to make? You have to dive into all of these things. And if you don't understand the sector, the industry, and how the business in itself works, I'll be the first to tell you, when I'm investing for the long term, I'm leaning more towards tech. I'm leaning more towards, consumer staples, restaurant stocks, because I understand these a bit more. I understand consumer trends. I have my thumb on that. I'm pretty good at that. But when I'm looking at what I don't understand, and I've been open about this on the channel, I understand them, but I don't feel fully, competent to invest. I'm talking about, energy stocks, oil, stuff like that. That's what I'm not into. I don't really invest there at all. And again, it's because I don't fully understand it. I'm more into tech. I'm more into the restaurants, consumer staples, and so forth. And I'm sticking with that, and I'm focusing on that. And I advise you guys to focus on what you understand and what you are competent in. And another way of putting this is the circle of competence. This came known by Warren Buffett. It's one of his big, rules in the market. Don't invest outside of your circle of competence, or, another way to put this in simpler terms is your circle of understanding. Don't invest outside of what you don't understand. So that's pretty much it. Let's recap this very quickly. I have the list right here. Number 1, what to avoid is investing and trading with money that you need in the short term. This is a big no-no, because if you take out the money, you incur a capital gain there. You lose money in a stock that had long-term potential that you wish you should have held. You don't want to be in that position. Rule number 2, what to avoid. Marrying a stock. Do not marry a stock, because fundamentals can change. That stock could end up, the business could end up deteriorating. And if you're sticking with it, riding the ship as it goes down, that is not good. And number 3, what to avoid, like we just said, is do not invest in what you do not understand. Do not trade what you don't understand. And that goes for options. And one thing I forgot to mention, leveraged ETFs as well. These very volatile, daily 300% mover ETFs, or they're meant to move 3 times what the underlying asset is. These are very risky to trade, and a lot of people end up bag holding them, and they end up in pretty bad situations. So those are 3 mistakes to avoid. Let me know some that you guys want to add to the list down below in the comment section, and let me know what you guys thought of the ones that I mentioned in this video. And if you guys found value in the video and you stuck till the end, I really appreciate you guys. Feel free to hit that like button for me if you guys did enjoy it. Also, get your 2 free stocks. Link down below in the description box from Webull. All you have to do is deposit $100 into the account, and it takes about 5-7 business days for you to get your 2 free stocks, and I also get 2 free stocks, and it does help out the channel here and all the free content that I'm putting up here on YouTube. So I'll catch you all in the next video. Thanks for watching. Again, as always, stay safe out there, guys. Peace out.